Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
There is a concern surrounding liquidity moving offshore, and that is a legitimate concern. It is obviously not good for Indian markets if liquidity moves offshore, and from that perspective, therefore, there will be some reaction.
Therefore, I'd said this, I don't know when it was, maybe it was 10 days ago, that there are various options that are being considered to see how we can consolidate liquidity in India.
Commercial decisions which they are taking, I don't think so it is retrograde, but they are trying to ensure that liquidity in those indices stay in the country.
We'll have to wait and see as to how protectionist the government becomes.
Indian stock exchanges are going Swadeshi in a move that will all but kill the SGX Nifty as a product. All the three stock exchanges have come together and declared that they will not give any data on Indian indices or share prices to foreign exchanges. Their defense is that liquidity migration is not good for India. Market regulator SEBI has backed the move, but some economists have termed it protectionist. Over the next 30 minutes, we speak to some of the best market experts to decode the impact of this decision. Good evening and welcome to this special show, The Exchange Wars. I'm Lata Venkatesh. Now, before I bring in my guests, my colleague Prashant Nair is here to explain why exchanges have taken this step and what, according to him, will be the impact. Prashant.
There are a couple of points of impact here. First of all, consider this. 52% of total trading activity which happens in Nifty futures, onshore plus offshore, happens offshore, happens in the SGX, happens in the Singapore Stock Exchange. So it tells you very clearly that that route was extremely popular. The instrument was extremely popular. Why is that? Taxes. I mean, people don't like to pay taxes. And if you traded in the Singapore Stock Exchange, the Nifty instrument, there was no short-term capital gains tax, whereas authorities would very clearly want foreigners to trade in India and pay taxes in India. What will SGX do now? In a call with investors, what the Singapore Stock Exchange essentially is saying is that they may launch a new derivative product to ensure continuity. We don't know what that is going to be. Is it going to be in consultation and agreement with the NSE at some future point? We don't know. They're also saying we will develop solutions from NSE's Gift City. I mean, again, we'll see what happens there. I mean, the Gift City where there are exchanges there. And they also say that they can continue to offer trading on single stock futures. The exchanges here, etc., really differ on that particular point. But the SGX and the call said that according to their understanding, since there is no licensing issue, they can continue to offer products on that one. What happens to the MSCI India index? I mean, basically, the rule says that any index in which Indian securities form 25% more or 25% or more of weight, and that index is offered for trade outside of India, I mean, that basically is going to be null and void. We're not going to offer data to those indices. The good news is, the good part is that India is only 9% of the MSCI emerging market index. Threshold is 25%, so there is no impact, which means MSCI India index will continue to remain relevant, but trading in MSCI India futures may have to stop. No confirmation from MSCI at this point, but that's the understanding from my conversation with market participants. Market impact locally, I mean, the stock market here was in fine fettle. The impact was on the Singapore Stock Exchange. The stock is traded, that fell. But back in India, foreigners who want to come and trade in India will have to register directly instead of looking for instruments like the SGX Nifty, which may not exist post-August when the notice period really ends. And this may also give a push to the Gift City, where the budget exempted people trading there from paying capital gains tax. Back to you.
Oh, thanks for that neat summary, Prashant. Let's get to our experts now. We're joined by Vaibhav Sanghvi of Avendus Capital Alternate Strategies. Vaibhav, thanks for joining. Well, my first question, basically, what is the impact if the SGX Nifty is absent in our lives?
Sure, a couple of things. One, let's take two points differently, in the sense that first, in terms of the opening of the markets, right? And till now, over the last good amount of time, people used to get an indication of what's happening or what's the mood on FIs by seeing what's being traded in terms of the SGX, in terms of whether it's likely to open higher or lower, and which actually reduced the opening volatility to a great extent. But that's on the very pretty much technical side. But in terms of the open interest, SGX used to carry about $8.5 billion of open interest in terms of Nifty, whereas our market was at about $4.5 billion or something like that. So what we need to see is basically whether this open interest gets shifted back to India. In all likelihood, we think that the larger part of that open interest will shift back to India, purely because whenever they used to trade on the SGX Nifty, the facilitator would hedge their own book by taking a counter trade into our exchanges as well. So on a outstanding open position perspective, I think you will see some amount of open interest being shifted from SGX to India, thereby increasing the liquidity over a period of time in Indian markets. So that's the more or broader impact of what's likely to happen.
Okay. So summer volumes can actually return to India is what you're saying. But Vaibhav, some people say that India's weightage in the MSCI indices can be impacted because SGX Nifty is not trading. Is that true?
Unlikely, because these instruments were actually derivative instruments, and I don't think MSCI would actually try and evolve around the derivatives tradability, whether it is happening in the overseas market or not. So I don't think the underlying fundamentals of the country, nor the other mechanics of being included into the MSCI is violated. So I don't. To my knowledge, it is unlikely that it will have an effect on the MSCI.
Okay. What about FIIs? You must be talking to a lot of them. Would they get bugged? Will they be less interested? Will it not make a difference at all?
No, I think we have looked at various instances like this, right from P notes where they were short sellers were not allowed, and subsequent to that you have seen huge amount of registration of FPIs coming onto the system as well. So these are actually all the steps in one direction, which means that the FPIs has to come in India and be liable to taxation in India by being compliant. So I think the policy way or the direction is very consistent and clear. It's just that we market participants keep on reacting, about these things pretty harshly. So I don't think it will be for sure not taken. I mean, it would not be taken negatively. And over a period of time, I think FPIs would directly come into India because India in itself is an attractive destination to invest.
Okay, that's good to hear. But SGX has said that it will offer a product based on the Nifty in India's gift city. What's your reaction to this? Looks like that seems to be the aim of the government after all.
I think SGX to mitigate their own volatility as well, I think would try to find options and ways and means to have those kind of trading onto their platforms and giving different products onto their platform. But I think we have to wait to see what can happen from the gift city as well, because in an overall scenario, gift city actually serves the same purpose of what as Singapore or Dubai would have been doing. So we will have to wait and see what are the kind of products come from those those areas, and the liquidity, how it emanates in those jurisdictions as well. So we'll have to wait.
Yes, fair point. Gift City will not start getting these products in a day. Vaibhav Sanghvi, thank you very much for joining us with your thoughts. So Vaibhav thinks that if anything, volumes in India will improve because those who are trading on the SGX Nifty could actually come and trade here, something that they were probably avoiding to prevent paying taxes. We will take a break on that note, but not everyone is in sync with what the NSE and the BSE have done. while we get into the break, we will also play out opinion that we got from Surjit Bhalla, who is member of the Prime Minister's Economic Advisory Council, as well Ajay Tyagi, the SEBI chief, as well as Vikram Limaye himself. We will come back and continue this discussion with Pramod Gubbi of Ambit Capital and Ajay Srivastava of Dimensions Corporate Finance.
I don't agree with the decisions, as you know, but it's opened up a debate, and I think we should have a very constructive debate on this as to what makes sense and what doesn't make sense, and in particular concentrate on the revenue side, and therefore the other side being the incentive side for investors. We'll have to wait and see as to how protectionist the government becomes and what are the arguments for imposing or getting SGX to collaborate with the gift city.
These are commercial decisions which they are taking. I don't think so it is retrograde, but they are trying to ensure that liquidity in those indices stay in the country. So I don't really say it is retrograde.
What we have outlined is a series of things that will try and consolidate liquidity in Indian markets rather than fragmenting liquidity. It has two components if you look at it. One is about licensing of indices that may be used for trading and settlement of offshore derivative contracts. So that would include our license with Singapore for the Nifty. What we don't want is other types of offshore derivative contracts, and that would also include the likes of single stock futures that was announced by Singapore.
We are discussing the cancellation of data provision by the NSE and the BSE to the SGX, the Singapore index, so that it could offer its product, its futures derivatives product, SGX Nifty. 6 months from now, the SGX Nifty, as we know it, will stop trading. What does that mean? What does it do to the image of India? What does it do to trading inside India? We are now probing those dimensions with Pramod Gubbi, the head of equities at Ambit Capital. Pramod, thank you very much for joining us. From the Singapore end, how does this action look? Does it look protectionist?
Yes, I mean, in some ways, it does look protectionist, but then you couldn't argue with the government if its intention is to bring most of this activity onshore, either through the gift city route or otherwise. But at the end of the day, does it end up achieving that objective? I'm not sure, because there's always the possibility of other products being launched.
That was going to be my next question. Is it possible to manufacture an entirely synthetic derivatives product without using the data from BSE or NSE? Is that possible at all? Indeed, it is quite possible. I mean, for starters, there are ETFs which get traded on the exchange anyways, so they mimic MSCI India. These are MSCI India trackers, and in fact, MSCI India perhaps is a benchmark that's been benchmarked by a lot more funds in terms of money managed than Nifty itself. So to that extent, it is already existing. But somebody could launch another index and launch futures on those index in any part of the world. So as long as there are investors chasing those contracts, it's definitely possible to replicate that. What will be the underlying for such a synthetic product? The underlying would be the constituents, the stocks which constitute the index. Okay. Just like, you can take MSCI India, for example. You can launch MSCI India futures, which is actually traded, but because of the availability of Nifty, because the volumes weren't much in MSCI India. So, for example, MSCI India could be a good guide to creating similar contracts. All right. Do you expect trading in MSCI India to be impacted because SGX Nifty is off? Possibly. I think we'll wait and see for the next few days. Next few days is unlikely because you still have time to log us. But maybe over time you might see pick up in volumes on those contracts. You don't see people who are trading on the SGX Nifty now shifting onshore to India, trading here and paying up the taxes? Yeah, at the margin, because on the futures trading bit, the returns are relatively muted as compared to those who invest from long term in cash equities. To that extent, the taxation makes
a meaningful difference. But yes, of course, if there are other incentives provided, like from what we understand, the gift city, there could be some tax rebates. It is the dollar denominated to the extent you protecting the currency as well. So all things being equal, yes, the tax makes a difference. But otherwise, if you are providing some SOPs, then you might still be able to attract some volumes.
Okay. How many countries find their offshore instruments so attractive? I guess the Chinese A shares are traded, but otherwise, are offshore indices very common?
Yeah, indeed. I mean, the FTSE, for example, or the MSCI, for example, have a lot of contracts on them on various markets,
Okay.
and by that, I guess it should be possible for India also to see those, as long as they are on a liquid platform. And attract a whole bunch of investors.
Okay. So this would make us look like outliers?
Yeah, sort of
Okay.
outliers, but at the same time, I think this industry keeps evolving. There's always a first time then.
Okay. What about, I mean, just to repeat that question, would these volumes come to India at all, you think? I was given to understand that volumes on the SGX Nifty, on Nifty futures, are almost double that of Nifty futures in India. So some of that comes to India, you think?
Yes, it should. It should certainly move to India, of which now how much will depend on two factors. One is what is the alternative that the regulators provide in terms of the gift city option or elsewhere. And second is what is the alternative contract that comes up either in Singapore or any other financial hub in the world, which provides the same features as the SGX Nifty. So based on these two, we'll get a sense maybe in 6 to 9 months' time to how much of those volumes we can successfully pull into India.
Okay. The provocation we understand is that SGX said it would offer, or not said, actually offered stock futures, which seem to be setting the stage for pulling away a lot of volumes from India. Would you say that that appears to be the provocation? Are such stock futures traded for other countries?
Well, I don't think it's a provocation, right? Because in any case, in stock futures, you don't have any tie-up with the exchange.
Okay.
And the stock futures will continue to get traded in SGX even beyond August.
Oh.
So that was always the provision, and SGX took that opportunity.
Oh, I see.
I'm not sure if that is the reason for the.
Okay. You mean stock futures can continue to get traded even if the Indian exchanges didn't provide stock prices?
Yep, as far as I understand, because it's only the Nifty which is licensed by the NSE.
Oh.
The stocks themselves are independent of the exchange.
And it is common that other countries' stock futures are also traded in exchanges like SGX and FTSE?
Yeah, indeed. I mean, the Chinese 8 shares, for example, trade in Hong Kong. So I guess there are several other examples. There are always dual listings in multiple exchanges, so I guess it's quite commonplace for that.
What do you expect will come in place of SGX Nifty? Is it most likely that Nifty the NSE will offer Nifty futures trading starting maybe 6 in the morning or something like that, and maybe continue to trade after hours, probably all the way till 10 p.m.? Is that the likely replacement?
I think that's one of the factors, right? One of the advantages of SGX was, of course, the extended timing.
Yes.
But also the fact that it was dollar denominated, and also the fact that you could, I mean, it was in a jurisdiction where, which is relatively tax friendly. Now, by extending the timings on the NSE, of course, you're solving for one problem. But if you can address the other two issues, it's quite probable that Nifty trading can move into India.
Okay. What about the NDF market for the foreign exchange itself for dollars? You think that the volume on the NDF market also will shrink somewhat, because that may have been related to exposures taken on the SGX Nifty, or is that more because of exposures on India, rupee exposures, and therefore the NDF market won't be impacted?
It'll be impacted at the margin, but I guess the NDF market is significantly bigger as compared to what the Nifty exposure was. And of course, the ultimate users are also various across corporate treasuries and so on. So maybe at the margin at best.
So how does life change from tomorrow? Or, well, not tomorrow, from 6 months from now?
I guess 6 months is a long way to go. We could even see some of these products come up within weeks, because it doesn't take much to structure something.
The one in the gift city, you mean?
Whether in the gift city or, say, somewhere else, either in Singapore or Hong Kong.
These ETF-based synthetic products, you mean?
Correct.
Okay. All right. Then if that happens, perhaps, India would not have saved too much of volumes. What's your best guess? Final question, Pramod Gubbi. Do volumes increase in India, or will the synthetic product just take away what SGX Nifty was getting?
No, I guess there will be some increase in volumes in India for sure. And like I said, depending on what sort of products come up and what sort of incentives the local government provides here, the extent of that increase will be determined by that.
All right. Well, we'll have to wait and see. It will be an interesting war of the exchanges, as we have called it. Thank you very much, Pramod Gubbi, for joining us with your insights. So it doesn't look like it's going to be a walkover for the Indian exchanges, that all the volumes that are being traded on the SGX Nifty, the Nifty futures, that is, will come to India. It's possible some of it comes, but it's possible that a synthetic product replaces the SGX Nifty in SGX itself, or if Indian authorities act quickly, we could have a Nifty futures getting traded in India's gift city, which is of course the place where Indian taxes don't apply. An interesting 6 months lie ahead, and maybe we will get an answer to it much earlier. We wrap up our special show, Exchange Wars. Stay tuned to CNBC TV18. News and updates continue.